Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Welcome back to the podcast, everyone. Today, we're going to focus on emerging markets with Peter Lampert. So, Peter, welcome back.
Thanks, Cam.
Thanks for spending time with us. So focusing on emerging markets, we've just kind of rolled through 2 years on the performance side of things. So you've been running the fund for 2 years. Why don't we start there and just give us a sense over the 2-year period you've started the fund, maybe some challenges, some changes to the team. Just give us an overview of the past 2 years.
Yeah, it's been a lot of fun, and we passed the 2-year mark on January 31st of this year. I think the number one thing for us is it's more of the same, what we do across our other funds at Mawer, following the same investment philosophy, but applying it directly and focused on emerging markets. So it's a lot of fun focusing on places like China, India, Brazil. There's a lot of excitement, a lot to learn. It's been a lot of learning, but a lot of fun too. And I think from the team perspective, the number one thing we've done is to continue to grow the team and to support our research efforts as we broaden our capabilities. And so we have about 30 people on the research team now, including 2 new analysts that we hired in 2017 in Singapore. And so they're based in our Singapore office there, and they give us a lot of help covering especially Asian companies, getting out there, meeting with management teams, traveling. And that's been a huge help to our process.
Was the intent in hiring people in Singapore, was that distinctly designed to beef up emerging markets? What was the intent of the firm behind that?
I think broadly, they're analysts on the team like the rest of us. We're generalists. They don't focus exclusively on Asia, but certainly they spend a lot of their time looking at Asian companies, and that supports definitely our emerging markets fund, but also our international equity and global equity funds and global small cap too. So Asia is becoming a bigger and bigger part of the global investment universe, and we've dedicated more resources to looking at those companies.
So Singapore is exciting in terms of having a full office there and 2 dedicated analysts. Can you give us a sense of number of trips we've done? So we have boots on the ground. That's a big thing for our process. Just give us a sense of how it's working out with 2 people in Asia now.
Meeting with companies and assessing the management teams has always been a big part of our process, and we all do a lot of travel from Calgary, and we continue to do that. But having 2 more analysts in Singapore that can travel around Asia is helpful. So I think across the team, we've probably done about 10 trips to different countries in Asia over the last 2 years, including our colleagues in Singapore and colleagues from Calgary making the trip over.
Thanks for that overview in the last 2 years, Peter. We do call this one Playing the Plan as far as the podcast goes. So let's get into the plan and kind of some specifics within emerging markets. So one curious thing I observed in the portfolio is the presence of emerging market banks. There's 2 in the top 10. So one's Brazilian and one is Indian. Why don't we just get into kind of the thesis behind having emerging market banks in there and just give people some sense of why are these attractive companies?
Yeah, for us, it always comes back to our investment philosophy. And the first pillar of that is looking for wealth-creating companies. The second one, excellent management teams. And the third point, at a discount to their intrinsic value. So we don't have any kind of preconceived notions that a bank is a good business or a bad business. It just comes down to finding companies that fit those criteria. And these happen to be 2 companies that fit that criteria very well. HDFC Bank in India, Itaú Unibanco in Brazil, both highly wealth-creating companies because of some of the nuances in those markets and in the businesses and the ways that the management teams have run the companies have resulted in very good returns.
Why is it wealth creating? Why are you particularly picking HDFC Bank?
They've been able to grow much faster than the general economy. So their earnings have grown about 20% a year pretty consistently. Compare that to Indian GDP growth is less than half of that. And the reason they've done such a good job is because they have such a strong management team that run the bank so well. They have a good customer base, which allows them to have good low-cost deposits. And they take those deposits and lend them to customers, but with very prudent underwriting, managing the risk well. And I think one of the advantages they have in India is many of the other competitors are state-owned or government government-run banks. And those are typically less efficiently run, less focused on finding the best customers. And that allows HDFC Bank to really carve out that niche focused on the high-quality customers where they can take less risk but earn high returns. And that's what's really resulted in good returns for the business and for shareholders.
Okay, thanks. Thanks for giving us that key distinction in terms of state-owned and independent. So let's talk quickly about the Brazilian market. Is it similar? Is the Brazilian market full of state-owned banks and finance companies and not, or is it an entirely different market?
There are a lot of parallels, and the investment thesis is actually pretty similar for Itaú as HDFC Bank. So again, it's an excellent management team. In this case, it's still owned by the original founding families. They still control the business. So having that family involved, they want to make sure the business is around for the next generation. So they've been conservative and prudent. And similar to HDFC Bank, they have identified good customers, have a good deposit base, and make prudent loans. And yes, they also compete against some less efficient government-run banks, which again gives them a nice competitive edge.
Okay, so those are similar qualities across two entirely different emerging markets. Peter, you're involved in the international equity team. There's no European banks in that model. So you're probably best placed to say, well, yeah, 2 of my holdings in emerging markets are banks, 2 of the top 10 holdings. Why not in Europe? Like, what are the distinctions that you're noticing between the marketplaces?
Yeah, the biggest distinction is that many or almost all European banks just don't meet our criteria on that first piece of our investment philosophy, being a wealth creating company. Most European banks earn very low returns on equities, mid to low single-digit ROEs, and they're just not beating their cost of equity. They're not delivering returns for shareholders. And that's due to a variety of reasons. It's just a much tougher banking environment in Europe. It's much more competitive. The regulators are tougher. And in management teams, by and large, haven't been able to navigate this difficult environment. So again, we don't take a view that banks are a good or bad business, but in Europe, it's pretty tough to have a wealth creating company that happens to be a bank.
And how does your experience in international equity help inform your emerging market, or vice versa? It's probably interesting discussions when you flip between the two strategies.
Yeah, and I think I work on our emerging markets and our international equity funds, but we take a very global perspective. We work closely with all of our colleagues across the research team, whether they're looking at Canadian equities or U.S. equities, and I think that's really helpful. I mean, we've found great banks in Canada and the U.S. too, and just seeing what works, what doesn't work, comparing regulatory environments, comparing competitive environments really brings that perspective and helps us to kind of focus in what we're looking for in finding a wealth creating company, regardless where it is in the world.
In terms of China in 2018, the stock market in China didn't do so well in 2018. Can you give us a little perspective on why you think that is the case? And then more specifically toward the portfolio, what are you doing about it?
The Chinese stock market was the worst performing major market in 2018. And some of the underlying factors, well, emerging markets in general sold off. And a lot of that is to do with interest rates. So with US dollar, Fed looking to increase interest rates in 2018, that's a headwind and results in capital outflows from emerging markets. We've seen that bounce back in 2019 here with the Fed shifting their stance, and maybe we'll have rates lower for longer. So China's been the best performing market so far year to date in 2019. But also the other big factor in 2018 was the Chinese government itself reducing liquidity in the economy. So there's been a lot of credit, a lot of lending in the economy, and they're concerned they need to manage some of these risks that have been building. And a lot of the lending has been happening outside of the formal banking sector. So in shadow banking and popping up in different ways, which is tough to regulate, tough to control, and could lead to a lot of risks and unintended consequences.
Peter, you mentioned shadow banking, and can you just explain to listeners what we mean by that?
They call them wealth management products, which is really just a euphemism for corporates packaging up and borrowing money from the end retail investors. So the end retail investors are buying these products and getting guaranteed high rates of return, but they're actually quite risky products and in many cases backed with long-term liabilities and short-term assets. So there's a mismatch there, and it's fairly risky. So the government's really been cracking down on that, trying to reduce that, taking liquidity out of the system, which has resulted, I think, lower strains on the economy and the financial markets in 2018.
Let's go drill into the portfolio in terms of when markets go down, maybe there's opportunities. So was China in 2018 sending any valuation signals to you that actually valuations are pretty attractive?
As bottom-up investors, we're looking to invest in great companies that we can hold for the long term. So we try to look through a lot of these volatility. And when we can find great companies, in this case, some of the companies that were on our watch list, prices came down, more attractive valuations. And we did add 2 new companies to the portfolio that happened to be based in China and sold off with the broader market. So the first one is Yili, the number one dairy company with 20% share of the milk market. It's a huge market. Consumption is not quite as high as Western countries, but kids are drinking milk. And what's important in China is that it's unlike, say, Canada, the brands are very important. There have been serious quality issues in the past. So Yili has that strong brand that people trust, and that's a strong competitive advantage. In addition to their distribution network and great management team that operates the business well. The issue for us was that the stock had been expensive in the past. With a more attractive valuation, we saw that as an attractive entry point. The second one is the Shanghai International Airport. They own and operate the Pudong Airport. If anyone's flown to Shanghai, they've gone through that airport. And what's great about this business is they have the major international airport, but with passengers coming in and out, and then there's a huge shopping mall inside. So they generate most of their revenue and profits from the duty-free sales, from renting out those stores and generating those retail sales from that captive traveler.
Just curious what the revenue model is. Is it your standard real estate model where here's your square footage, you put a store in there, you pay a lease? Or is it, in addition, they're taking a percentage of sales?
That's right. They typically take a percentage of sales in the lease. There are minimums involved, but most of the stores are well above those minimums and paying a percentage of sales. And what's great is that the leases just came up for renewal, and Shanghai International Airport doubled its take on those rents because they had been undercharging in the past, and so now it's going to be even more profitable going forward.
So it's a catch-up. Can they do that every renewal period? Are they going to double it every period?
This is probably the sustainable level going forward.
Okay, so you can expect regular kind of inflation-related increase in lease. Is there any one retailer that's prominent across airports globally? Like I'm just thinking, if it's percentage of sales, then you want the best-selling products to be in your airport. I'm just trying to think of it for a minute. So do you have a sense of that from Shanghai to Hong Kong to, like, what are the differences?
Yeah, I mean, in this case, they enter into the lease with the duty-free operator, who in turn attracts the end brands like the Pradas and Gucci's. But certainly there's a very high portion of those luxury products that generate those big revenues.
To me, it sounds like it's basically a shopping mall with runways. Is that kind of how you look at it? And that's a global business. So would there be other emerging markets where you're actually looking for that type of business?
Yeah, there are other listed airport companies around the world. Oftentimes they're not listed or they're owned by governments, but certainly it can be a great business. And we've taken a look at most of the listed ones. In many cases, the valuations are quite high, but with the pullback we saw in China, I think Shanghai Airport was trading at quite a reasonable valuation, which is one of the big differences. In addition to the growth runway that they have with more and more traffic coming through Shanghai, they're expanding the airport and getting more passengers, which should result as well in more retail sales.
So let's shift gears a little bit, Peter. And what I want to give listeners a sense of is when things don't go quite according to plan. So in 2018, Samsung is a holding that didn't perform that well for the portfolio. But what about that is not meeting your expectations? And how do you manage maybe the risk in the portfolio?
Samsung Electronics was one of the worst performers for us in 2018. When most people think of the company, they're familiar with probably their phones or maybe some of their other consumer electronics. But really the key for our investment thesis is their semiconductor business. And they're the largest maker of memory, DRAM and NAND memory chips, which go into pretty much every electronic, whether it's your phone, your computer, any electronics use a memory chip. So they're the largest maker. They have a great economies of scale. They're incredibly well run and operationally efficient, which has allowed them to earn the highest margins in the industry. It's a consolidated industry with really only 2 or 3 major competitors in addition to Samsung. So that's really the cash cow and been a great business for them. It is, however, a very cyclical business. Memory is pretty much a commodity, and when new supply comes on, prices come down. And what we've seen is there has been new supply. Samsung itself has been bringing on new fabs to build more memory and expanding their capacity. Meanwhile, demand growth had been very strong, and that's starting to slow. We've seen a slowdown in smartphone sales, which is one of the big end markets, potential slowdown in autos and pretty much anything that uses electronics. So with that slowdown, demand coming down, but supply has come online. This is pretty typical in a cyclical industry where profits could be expected to come down. And they haven't yet. They started to only last quarter. Prior to that, they were still earning record profit levels. And this cycle might go on a bit further and profits come down a bit more. For us as long-term investors, I mean, we're willing to see through those cycles and ride out that volatility. And on a 10-year view, even in the worst down cycles, when Samsung's competitors are losing money, it's always been still profitable. And we expect that to happen again this time. And given the valuation, we think it's very attractive on a long-term view, and we're more than willing to ride out those cycles.
Okay, so I'm hearing willing to ride out, but are you willing to add to the position? Like, how do you feel about the position size here?
I think our position's reasonable right now. It's about 2.5% weight in the emerging markets portfolio. And given the risk return, we do have some concerns with the business, but given the risk return and that attractive valuation, it's a pretty good weight for us today.
Thanks for giving us that detail and for talking about a stock that's not quite performing up to expectations. So let's shift gears a little bit and talk about current holding, but let's kind of take those 3 tenets of our philosophy and just cover the reasons why. So maybe I'll introduce the name of the portfolio. It might be nice to have this in your portfolio. So it's Korean stock and it is all caps. So we don't know if you pronounce it NICE or NICE, but it's Nice Information Service. So over to you, Peter.
Nice Information Service has been a stock in the portfolio for about 2 years, and they operate credit bureau in Korea. Many people will be familiar with similar businesses, Equifax, Experian in other markets, and they're one of 2 credit bureaus in Korea.
Why is it a wealth creating business?
Yeah, it's a great wealth creating business, has historically earned high returns on capital. And the reason is that strong competitive advantage they have in the database. They have a database with the credit information on nearly every person in South Korea. And they're only one of 2 companies that do this. And they have only one of 2 companies that have the government license to do this. So there's a number of barriers in there. First is having the government license. Second is having the database. The value in the data is that it's broad, it covers the whole population, and it's long. They've been doing this for 30 years. So when banks and financial customers want to write a loan, they'll pay NICE to check the credit bureau. Having that information is a small cost but high value to their customers.
Second tenet, management.
Managements run the business very well. They focus on the core business of the credit bureau, and they've acquired one of their smaller competitors. There previously had been 3 competitors to consolidate that market and really strengthen their market position. In addition to that, though, management also has a growth focus. Many companies with such a strong core business, many companies we see would just rest on their laurels, harvest those nice cash flows, and call it a day. What management's done in this case is continue to find new ways to grow, use their position to try to add adjacent products, add more products for their customers, and use that data in new ways. So they're always looking to grow. And that ties into the third piece you didn't ask yet, but about valuation. We think that we're getting some free options here, which we love to find. If we can pay a fair price for a great business and get some free options, if some of these new growth opportunities come out that management's working on, if they're successful, we don't think we're paying for that, and that would be some nice upside to the stock.
Okay, good. So we've covered NICE in all 3 tenets. Thank you for that profile. What I want to conclude on is where do you feel the portfolio is right now? Are you looking to add more names over time? Are you comfortable with how many names in the portfolio? Like, where do you want to take the portfolio going forward, Peter?
And today there are about 45 stocks in the portfolio. We're comfortable with that. We think it's a well-diversified portfolio, but still concentrated enough to have higher weights in some of our best ideas. In terms of the positioning, our goal is always to have a resilient portfolio of good companies that meet our investment philosophy and that we can hold for the long term. Emerging markets can really get whipped around, especially on the changes in interest rates and Fed policy. But for long-term investors, we think holding wealth-creating companies run by excellent management teams and buying them at discount to intrinsic value over time, this should result in good returns.
Awesome. Thanks for playing the plan on emerging markets, Peter.
Thanks, Cam.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.